Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most important books an investor can ever read, Financial Shenanigans, by the legendary accounting detective Howard Schilit. We'll break down the sneaky tricks companies use to make their financial performance look better than it really is. We're going to cover the 7 core shenanigans. From recording revenue too soon to manipulating cash flow, giving you the tools to spot the red flags before they cost you money. Whenever we can, we try to answer questions left in the comments. Financial literacy is a journey we all take together, and learning from each other's experiences is incredibly powerful. So please, feel free to share your own stories, ask any questions you have, and let's build a community of smarter, more aware investors. All right, let's get started. Imagine you're a detective. Your crime scene isn't a dark alley. It's a company's financial statements, the income statement, the balance sheet, and the cash flow statement. Your suspect isn't a person in a ski mask. It's a management team under immense pressure. The weapon? Not a knife, but a set of accounting rules that can be bent, twisted, and sometimes outright broken. This is the world Howard Schilit invites us into. He's essentially giving us a forensic accounting toolkit. The fundamental question is, why would a company do this? The answer is simple: pressure. Pressure from Wall Street to meet quarterly earnings estimates. Pressure to keep the stock price high. Pressure to secure a bonus. It's like a star student who has always gotten straight A's. The pressure to maintain that perfect record can lead them to, let's say, get a little creative on their next exam. For companies, that exam happens every 3 months, and the entire market is watching. Schilit organizes these creative accounting techniques into several categories, which he calls shenanigans. We're going to walk through the 7 most critical ones. Think of these as the 7 deadly sins of corporate accounting. Mastering them will change the way you look at a company's financials forever. You'll go from being a passive reader of numbers to an active interrogator of them. The first, and perhaps most common shenanigan, is recording revenue too soon or of questionable quality. This is a classic. A company is supposed to record revenue when it has been earned and when collection is reasonably assured. That sounds straightforward, but the definition of earned can be stretched like warm taffy. A company might ship goods to a distributor at the end of a quarter, knowing full well that a large portion of those goods will be returned in the next quarter. But for this quarter, it's booked as a sale. This practice even has a name: channel stuffing. It's like a beverage company forcing a supermarket to take 10 times more soda than it can possibly sell in December, just so the beverage company can hit its annual sales target. The supermarket might have a side agreement allowing them to return the unsold soda in January, but the revenue gets booked in December anyway. It's a house of cards, making the present look great at the expense of the future. Another way this shenanigan plays out is with long-term contracts. Imagine a software company signs a 3-year, $3 million deal with a client. The proper way to account for this is to recognize $1 million of revenue each year. The shenanigan? The company might try to book all $3 million on day 1, the day the contract is signed. Suddenly, a company that earned $1 million looks like it earned $3 million. Their sales and profits for the current period are massively inflated, but it's a phantom gain. So how do you spot this? One major red flag is when a company's accounts receivable are growing much faster than its sales. Accounts receivable is the money that customers owe the company. If this number is ballooning, It could mean the company is booking a ton of sales to customers who aren't paying their bills on time, or maybe never will. It's a sign that the quality of their reported revenue is poor. Now for the second shenanigan, recording bogus revenue. This one is less about timing and more about outright fabrication. It's one step closer to fraud. This is when a company creates revenue out of thin air. One of the most fascinating ways this is done is through what are called round-trip transactions. This is a scheme where two companies conspire to inflate their revenue. Here's how it works. Company A sells an asset or a service to Company B for, say, $10 million. Then, in a separate but related agreement, Company A agrees to buy a completely different asset or service from Company B for the exact same amount, $10 million. No real cash changes hands in the end, and no real business of value was conducted. But guess what? Both Company A and Company B just got to record an extra $10 million in revenue. It's pure fiction. A real-world example of this happened during the dot-com bubble, where struggling tech companies would sell each other useless web advertising space or unused fiber optic cable capacity just to create the illusion of business activity. Another form of bogus revenue is simply recording sales that never happened or classifying investment income as revenue. This is harder for an outsider to spot, but it highlights the importance of being skeptical, especially when a company's growth seems too good to be true. The third shenanigan is boosting income with one-time gains. This is a clever way to mislead investors about the core profitability of a business. Imagine a struggling retail company. Their sales are down and their profits from selling clothes are negative. But they happen to own the building their headquarters is in, and they bought it 40 years ago. They decide to sell the building and lease it back. Because real estate values have soared, they make a $200 million profit on the sale. Now, here's the shenanigan. In their press release, they announce a fantastic quarter with record-breaking net income. They conveniently bury the fact that the entire profit came from this one-time sale of a building, and their actual business of selling clothes is losing money hand over fist. They're mixing non-recurring, one-off gains with recurring operating income. As an investor, you have to be able to separate the two. A company's long-term value comes from its ability to generate profits from its core business, year after year. Selling an asset is like selling the family silver to pay the rent. You can only do it once, and it doesn't solve the underlying problem. This figure excludes one-time gains and losses and gives you a much clearer picture of the company's sustainable health. Let's move to the other side of the income statement, expenses. Shenanigan number 4 is shifting current expenses to a later, earlier period. The most famous way this is done is by improperly capitalizing costs. I know, that sounds like accounting jargon, so let's break it down with a simple analogy. Imagine you own a pizza shop. The cost of flour, tomatoes, and cheese are clearly expenses. You use them up to make a pizza, and that cost is recognized right away, reducing your profit for that day. But what if you buy a brand new $50,000 pizza oven? That oven will last for 10 years. It would be wrong to say your business lost $50,000 on the day you bought it. Instead, accounting rules allow you to capitalize that cost. You treat it as an asset and then you expense a portion of its value each year over its useful life. This is called depreciation. So, you might expense $5,000 a year for 10 years. The shenanigan happens when a company starts treating its regular, everyday expenses as if they were long-term assets. They take costs that should reduce this year's profit and instead hide them on the balance sheet, only to have them trickle out as small depreciation charges in future years. The result? This year's profit looks amazing. The poster child for this shenanigan was the telecom giant WorldCom. In the early 2000s, they took over $3.8 billion in normal operating costs, things like fees they paid to other telecom networks, and fraudulently capitalized them. They pretended these were long-term investments. This single move turned massive losses into huge reported profits, fooling the entire market until the fraud was uncovered, leading to the largest bankruptcy in US history at the time. It shows just how powerful and dangerous this shenanigan can be. Now, for a shenanigan that sounds a bit strange at first. Number 5. Shifting future expenses to the current period. Wait, why would a company want to make its current profits look worse? This is a sophisticated game. It's often called taking a big bath. This usually happens when a company is already having a terrible year, or when a new chief executive officer takes over. The thinking is this: well, this year is already a total write-off. Wall Street already hates us, so let's dump every possible future expense into this year's results. Let's write down the value of our inventory. Let's prepay for future marketing. Let's create massive restructuring charges for layoffs we might do over the next 2 years. Let's get all the bad news out of the way at once. The benefit? The current year looks awful, but the company exceeds expectations. Then, the next few years look incredible by comparison. With all those expenses already paid for in the past, future profits will be artificially high. The new chief executive officer looks like a turnaround genius. It's a way of cleaning the slate to set a very low bar for future performance. As an investor, if you see a company reporting a massive one-time charge or a huge restructuring, ask yourself if they are just cleaning house to make the future look brighter than it really is. The flip side of that coin is our 6th shenanigan, shifting current income to a later period. Again, this seems counterintuitive. Why would a company hide good news? The answer is earnings smoothing. The market loves predictability. A company whose earnings are a roller coaster, up 50% one quarter, down 30% the next, is seen as volatile and risky. A company with smooth, steady growth of, say, 5% every single quarter is rewarded with a higher stock price. So, if a company has a truly blockbuster quarter, they might be tempted to hide some of that income to save for a rainy day. They create a cookie jar of reserves. A common way to do this is by creating an excessive allowance for bad debts or sales returns in a very good year. They overestimate how much money they'll lose from customers not paying. This reduces their reported income now. Then, in a future, weaker quarter, they can dip into that cookie jar. They'll say, you know what? It turns out our customers are more reliable than we thought. They'll reverse some of those previous reserves, which flows directly into the income statement as a profit boost. It's a way of managing expectations and creating the illusion of smooth, predictable performance. This is why you should be just as skeptical of a company that always perfectly meets its earnings targets as you are of one that is all over the place. Perfect smoothness is often unnatural. So far, we focused mostly on the income statement, but savvy investors know that cash is king. Earnings can be manipulated with accounting assumptions, but cash is much harder to fake. Or is it? This brings us to the 7th and final shenanigan, which focuses on the statement of cash flows, shifting financing cash inflows to the operating section. This is one of the most brilliant and devious shenanigans Schilit highlights. First, a quick refresher on the cash flow statement. It's broken into 3 parts. First, cash flow from operations, or CFO. This is the cash generated by the company's core business activities. It's the most important number. A healthy company should generate lots of positive CFO. Second, cash flow from investing, which is cash used to buy assets or generated from selling them. And third, cash flow from financing, which is cash received from borrowing money or issuing stock. Investors want to see high and rising cash flow from operations. It's the engine of the business. A shenanigan occurs when a company takes cash that should be in the financing section, like cash from a loan, and finds a way to make it look like it came from operations. This makes the core business look incredibly healthy and cash-rich, when in reality, it's just borrowing money. How on earth do they do this? One common technique is selling accounts receivable. Remember those IOUs from customers? A company can package them up and sell them to a bank for immediate cash at a small discount. Now, this is functionally a loan. The bank has given them cash, secured by the promise of future customer payments. It is a financing activity. However, under some accounting rules, companies can get away with classifying the cash they receive from this as cash flow from operations. It's a loophole big enough to drive a truck through. A huge red flag for investors is a company that consistently reports strong net income, but weak or negative cash flow from operations. The income statement says they're profitable, but the cash flow statement says the cash isn't showing up. This divergence is often the first and most powerful sign that some kind of earnings manipulation is happening. The company is booking profits, but those profits aren't converting into real cash. Eventually, that disconnect has to be resolved, and it's usually not in a good way for shareholders. In later editions of his book, Schilit and his co-authors added more shenanigans, particularly around the use of what are called Non-GAAP metrics. GAAP stands for Generally Accepted Accounting Principles, the official rulebook. But companies have started inventing their own performance metrics, like adjusted EBITDA or pro forma earnings. What are these? They are basically the company's version of their earnings, but with all the bad stuff taken out. A company might present an adjusted profit figure that excludes restructuring costs, stock-based compensation for their employees, and litigation expenses. They're essentially saying, here's how much money we would have made if we didn't have to pay for all these very real costs of doing business. It's like calculating your personal budget, but deciding to exclude your rent and car payment. Sure, it makes your savings look great, but it's completely disconnected from reality. When a company heavily promotes a non-GAAP metric that is wildly different from its official GAAP net income, you should be extremely cautious. It's often a sign they are trying to distract you from poor performance under the official rules. So, what are the big takeaways from all of this? How do you put this detective manual into practice? First, you have to accept that financial statements are not just a sterile presentation of facts. They are a narrative, and the management team is the narrator. And that narrator might be unreliable. Your job is to read between the lines and question that narrative. A practical step is to always read the footnotes in a company's annual report. That's where the bodies are buried. The main financial statements are the summary. The footnotes are where the company is legally required to explain the assumptions they used. You'll find details on their revenue recognition policies, how they value their inventory, and any major one-time events. It might seem dense and boring, but it's where the truth often lies. Another incredibly powerful tool is to compare a company to its direct competitors. If one company in an industry suddenly has profit margins that are double everyone else's, you need to ask why. Do they have a revolutionary new product? Or are they just using more aggressive accounting? Comparing trends across an industry can make an outlier and a potential shenanigan stand out in sharp relief. Also, Be wary of companies that are serial acquirers, companies that are constantly buying other companies. Mergers and acquisitions create enormous accounting complexity. They generate a lot of goodwill on the balance sheet and offer numerous opportunities to play games with expenses and revenue recognition. While some acquisitions are strategically brilliant, a pattern of constant deal-making can also be a sign of a company trying to buy growth and obscure problems in its core business. Ultimately, the lesson from Howard Schilit is one of healthy skepticism. It's not about assuming every company is committing fraud. Most are not. But it is about understanding the pressures they face and the tools at their disposal to present a rosier picture. It's about recognizing the difference between high-quality, sustainable earnings backed by cash and low-quality, artificial earnings built on a foundation of accounting tricks. The most enduring piece of wisdom is the relationship between earnings and cash flow. If a company tells you it earned $1, you should be able to find that dollar somewhere in the cash flow statement. If net income is consistently growing while operating cash flow is stagnant or falling, a loud alarm bell should be going off in your head. That divergence is the smoke that often leads to the fire of a major financial blowup. Learning to spot these shenanigans is a skill that takes time to develop, but it's one of the most valuable skills you can have as an investor. It protects your capital from catastrophic losses and forces you to invest only in high-quality businesses with transparent, honest management. It transforms you from a spectator into a true financial analyst, capable of making your own judgments instead of just following the crowd. The numbers tell a story, and thanks to the work of people like Howard Schilit, you now have the grammar and vocabulary to understand what they're really saying.